Welcome to the Bitcoin Street Journal podcast. I'm your host, Autumn, and we are absolutely flying high today with Bitcoin sitting pretty at $112,288. That's up 1.3% and climbing. This is Friday, September 5th, 2025, and folks, we are witnessing history in the making.
And I'm Darren, your Bitcoin Maximalist co-host, and let me tell you, we're not just witnessing history, we're living through the greatest financial revolution of our lifetime. Public companies are now holding over 1 million Bitcoin. That's 4.7% of the total supply. When institutions move from the traditional 1% allocation to 5%, we're talking about a potential $1.5 trillion demand tsunami.
Speaking of tsunamis, Darren, the Federal Reserve is hosting their first ever conference on stablecoins, DeFi, and tokenization this week. And get this, Ray Dalio just called Bitcoin a, quote, legitimate hedge against traditional financial risks. The narrative is completely shifting.
Autumn, Bitcoin dominance is sitting at 56.6%, while altcoins are getting absolutely demolished. Strategy just dropped $449 million on Bitcoin, bringing their total to over 630,000 Bitcoin. The institutional shift from 1% to 5% allocations isn't theoretical anymore. It's happening right now.
And the SEC just opened the doors for spot crypto trading with NASDAQ tightening oversight. We've got $4.5 billion in Bitcoin options expiring today, with max pain sitting right at our current price level. This is no coincidence, people.
Remember, folks, not your keys, not your Bitcoin. But before we dive deeper, let's talk about this corporate treasury tsunami that's about to wash over traditional finance. Buckle up.
But before we dive into the corporate treasury revolution, let's take a moment to appreciate what we're actually witnessing here. Bitcoin at $112,000 isn't just a number. It represents the largest wealth transfer in human history, from those who understand fiat debasement to those who don't. Every single day that passes, more people wake up to the reality that holding government currency is a guaranteed losing proposition. Let's get you caught up on where we stand right now. Bitcoin is trading at $112,288, up 1.34% on the day, with a high of $112,965. Market cap is sitting at a massive $2.237 trillion.
And that Bitcoin dominance at 56.6%, that's telling the real story here, Autumn. While Bitcoin continues its relentless march upward, altcoins are bleeding out. Today, we've got $4.5 billion in options expiring, with max pain right at $112,000. The market makers knew exactly what they were doing.
Trading volume is absolutely massive at $42.7 billion, and here is a stat that should blow everyone's mind. We've now mined 19.91 million of the 21 million total Bitcoin. That's 94.8% of all Bitcoin that will ever exist.
And with public companies holding over 1 million Bitcoin, 4.7% of the entire supply, we're looking at a supply shock that traditional finance has never seen before. When institutional allocations shift from 1% to 5%, that's $1.5 trillion in potential new demand chasing a rapidly diminishing supply. The math is absolutely mind-blowing. And let me paint the technical picture for our listeners, Autumn. We're seeing absolutely massive on-chain metrics that traditional analysts are completely missing. Bitcoin addresses holding more than 1,000 Bitcoin have increased by 12% this quarter alone. These are whale accumulation patterns that typically precede major price movements. The realized cap is sitting at $700 billion, meaning the average Bitcoin holder is sitting on massive unrealized gains, yet they're not selling.
Now, let's dive into the main event, this corporate treasury explosion that's reshaping how companies think about their balance sheets. Strategy, it just announced a jaw-dropping $449 million Bitcoin purchase, bringing their total holdings to over 630,000 Bitcoin.
Autumn, this isn't just strategy. This is a complete corporate awakening. Bitmine is approaching 2 million in Ethereum. Tom Lee's company is holding 153,000 Ethereum worth $8.98 billion. And Pineapple Financial just announced a $100 million injective treasury allocation.
The diversification strategies are fascinating too. We're seeing corporate treasuries moving into Solana, BNB, TON, but here's what's really significant. Ray Dalio's endorsement of Bitcoin as a legitimate hedge. When one of the world's most respected macro investors validates Bitcoin, that sends shockwaves through institutional circles.
And don't forget, NASDAQ is tightening oversight on these crypto positions, which actually adds legitimacy to the space. American Bitcoin launched with 273 million in Bitcoin and saw a 72% jump on day one. The market is literally rewarding companies for adding Bitcoin to their treasury.
What I love about this trend is how it's democratizing Bitcoin adoption. When major corporations hold Bitcoin in self-custody, it proves the viability of the self-custody model for regular investors too. If a billion-dollar company can safely store their Bitcoin, so can individual investors with proper education and tools.
Exactly. And here's the kicker. These aren't speculative plays anymore. These are sophisticated treasury management decisions by companies that have done their homework. They're recognizing that holding fiat is a guaranteed loss against inflation, while Bitcoin offers a verifiable, scarce digital asset with a 16-year track record of outperforming every other asset class.
Now, let's zoom out and talk about the macroeconomic landscape that's driving this corporate adoption. Global debt just crossed $315 trillion. That's 4 times global GDP. Central banks worldwide are trapped in a system where they must continue printing money to service this debt, which means every dollar, euro, and yen is losing purchasing power by design. Smart corporate treasurers are recognizing that Bitcoin isn't risky. Holding fiat is the risky position.
Exactly, Autumn. And here's what's really fascinating. We're seeing negative real interest rates across major economies, meaning if you hold government bonds, you're guaranteed to lose purchasing power after accounting for inflation. Meanwhile, Bitcoin has delivered average annual returns of over 160% since inception. The risk-adjusted returns make traditional asset allocation models look absolutely primitive. When pension funds and insurance companies start doing the math, the demand shock is going to be unprecedented.
Now, let's talk about what might be the most significant regulatory development in crypto history. The Federal Reserve, yes, the Federal Reserve is hosting a conference this week on stablecoins, DeFi integration, and tokenization. This is the same institution that was calling Bitcoin digital tulips just a few years ago.
Autumn, this is absolutely revolutionary. The SEC and CFTC are opening the doors for spot crypto trading, and BlackRock's ETF just saw 281 million in inflows, adding 2,588 more Bitcoin to their holdings. They're now sitting on 750,000 Bitcoin worth $82.21 billion.
What's fascinating is how Bitcoin is becoming increasingly uncorrelated to traditional economic data. Jobs reports, inflation numbers, Fed announcements. Bitcoin is developing its own monetary gravity that operates independently of legacy financial metrics. We're witnessing the maturation of an alternative monetary system in real time.
This regulatory shift represents the institutionalization of crypto at the highest levels. When central banks start hosting conferences about tokenization and DeFi, that's not just acceptance, that's preparation for integration. The traditional financial system isn't fighting Bitcoin anymore. They're figuring out how to coexist with it and ultimately how to benefit from it.
Speaking of global integration, let's talk about what's happening internationally, because the Bitcoin adoption story extends far beyond American borders. El Salvador's Bitcoin reserves are now worth over $400 million, generating massive profits for their citizens. President Bukele's bet on Bitcoin has paid off spectacularly, and other nations are taking notice. Dubai just launched the world's first Bitcoin-backed bonds, and Switzerland continues to lead in crypto-friendly regulations. We're seeing a race between nation-states to become Bitcoin-friendly.
And don't forget about the Central African Republic making Bitcoin legal tender.
Argentina electing a Bitcoin-friendly president, and even traditional financial centers like Singapore and Hong Kong embracing crypto innovation. But here's the real kicker. While Western nations debate regulations, countries with weaker currencies are adopting Bitcoin out of necessity. Nigeria, Turkey, Lebanon, their citizens are using Bitcoin to protect themselves from hyperinflation. This isn't speculation anymore, it's survival.
Let's talk about the raw power securing the Bitcoin network right now. We just hit a record hash rate of 1 zettahash per second on a 7-day average. For context, that's more computing power than all other computing networks on Earth combined.
Autumn, people don't grasp the magnitude of this. 1 zettahash per second means that attacking Bitcoin would require more energy than most countries produce in an entire year. This network is becoming literally untouchable from a security standpoint. Miners are making massive long-term investments in infrastructure because they see the writing on the wall.
The energy efficiency story is incredible too. While traditional banking systems burn through massive amounts of energy for clearing, settlements, physical branches, and data centers, Bitcoin's energy use is transparent, increasingly renewable, and serves a single purpose: securing the most robust monetary network in human history.
And here's the beautiful part. As the hash rate increases, miner profitability stabilizes, which creates a positive feedback loop for network security. Higher security means more institutional confidence, which drives more adoption, which increases the value, which attracts more miners. It's a virtuous cycle that's been running flawlessly for 16 years.
Let's talk about the technological innovations happening in the Bitcoin ecosystem that mainstream media completely ignores. The Lightning Network now has over 5,000 public nodes and growing exponentially. We're seeing instant, practically free Bitcoin transactions that make traditional payment systems look like horse and buggy. And with Taproot activation, Bitcoin now supports more sophisticated smart contracts while maintaining its security and decentralization principles.
Autumn, the technology stack being built on Bitcoin is absolutely mind-blowing. We've got Liquid Network for institutional trading, Lightning Network for micropayments, and now emerging technologies like RGB and Taro that enable tokenization directly on Bitcoin. But here's what separates Bitcoin from every altcoin. All these innovations are built without compromising the base layer security or decentralization. Other projects sacrifice security for features. Bitcoin adds features while maintaining security. That's the difference between sound engineering and venture capital hype. All right, everyone, it's time for my favorite segment. Shitcoins getting wrecked while Bitcoin wins again. Let's talk about why Bitcoin dominance at 56.6%. It's absolutely crushing the altcoin casino.
Oh, this should be good. Darren, what's the carnage looking like in altcoin land while Bitcoin marches for new all-time highs?
Autumn, let's start with Ethereum transaction fees that are still higher than most people's daily coffee budget, while Lightning Network transactions cost fractions of a penny. DeFi total value locked is at $127 billion, but we just saw another $8.4 million exploit at Booney. Meanwhile, Bitcoin has never been hacked.
And don't get me started on smart contracts delivering malware. We're seeing more security exploits every week while Bitcoin's protocol remains unchanged and unbreached. Sure, Solana had some nice price performance, but they also had, 3 network outages this year alone?
Exactly. Bitcoin has maintained 99.98% uptime for 16 years straight. While other networks promise the world and deliver downtime, Bitcoin just works day in, day out, block after block every 10 minutes like clockwork. And don't even get me started on governance tokens. Buying votes in a decentralized system? That's not decentralization. That's just democracy with extra steps.
The institutional money speaks volumes here. When corporations need to protect their treasury, they're buying Bitcoin, not governance tokens or DeFi protocols. There's a reason for that. Bitcoin is digital gold. Everything else is a science experiment. You know what, Darren? This brings up a crucial point about Bitcoin's design philosophy that I think our listeners need to understand. Bitcoin was designed with one primary purpose: to be the hardest money ever created. Every decision in Bitcoin's development prioritizes security, decentralization, and immutability over flashy features or short-term convenience. That's why Bitcoin doesn't have smart contracts that can drain your wallet, doesn't have governance tokens that can change the rules, and doesn't have validators that can censor your transactions.
That's exactly right. Bitcoin is like the ultimate savings technology, boring by design. While other cryptocurrencies chase venture capital funding with promises of revolutionizing everything from supply chains to social media, Bitcoin focuses on one job, being perfect money. And after 16 years, it's proven that focusing on that one job creates more value than trying to do everything poorly. The market is finally understanding that decentralized money is the killer app, not decentralized computing or decentralized storage. Everything else can be built on top of perfect money.
Time for our lightning round. Let's rapid fire through the biggest takeaways from today. Darren, why should people care that corporate treasuries are choosing Bitcoin over bonds?
Because it proves Bitcoin is becoming the new risk-free asset. When Fortune 500 companies dump low-yield bonds for Bitcoin, they're essentially saying Bitcoin is less risky than government debt.
What does 1 million Bitcoin in public company treasuries really mean for supply dynamics?
It means 4.7% of all Bitcoin is now locked in corporate treasuries with no intention to sell. As more companies follow this trend, available supply shrinks dramatically while demand explodes.
Fed hosting a DeFi conference. Paradigm shift or just keeping up appearances?
Total paradigm shift. Central banks don't waste time on things they plan to ban. They're preparing for a world where crypto and traditional finance coexist, and they want to understand the rules of engagement.
Record hash rate. Why should regular investors care about mining infrastructure?
Higher hash rate equals unbreachable security. Your Bitcoin becomes more valuable when it's protected by the most powerful computing network in human history. Security is the foundation of store of value.
Before we close out today's show, I want to take a few minutes for our educational segment because with all this institutional adoption, we can't forget the fundamental principle that makes Bitcoin special: self-custody. For our listeners who are new to Bitcoin, let me explain why "not your keys, not your Bitcoin" isn't just a slogan, it's the entire point. When you hold your own Bitcoin keys, you become your own bank. No counterparty risk, no bail-ins, no frozen accounts, no restrictions on how you spend your money.
This is so important, Autumn. Look, we celebrate these corporate treasuries holding Bitcoin, but ultimately, the most powerful aspect of Bitcoin is that regular people can hold it without permission from any institution. A hardware wallet costs less than a nice dinner out, but it gives you the same monetary sovereignty that only kings and central banks had throughout history. Every person listening can download a wallet app, generate their own private keys, and become their own central bank. That's revolutionary.
And let's talk about practical strategies for our listeners. Dollar cost averaging into Bitcoin is probably the most powerful wealth building strategy available to regular people today. Instead of trying to time the market, which even professional traders fail at, you can automate weekly or monthly Bitcoin purchases. Over any 4-year period in Bitcoin's history, this strategy has generated massive returns. The key is consistency and long-term thinking, not trying to predict short-term price movements.
Exactly. And here's the mindset shift people need to make. Stop thinking about Bitcoin in dollar terms and start thinking in Bitcoin terms. When you buy coffee, don't think this costs $5. Think this costs 8,000 Satoshis. When you see a car priced at $30,000, think that's 0.26 Bitcoin. This helps you understand that Bitcoin is becoming the unit of account, not just an investment. We're moving towards a Bitcoin standard, not a dollar standard with Bitcoin as a speculative asset.
One last educational point before we wrap up. Let's address the environmental FUD once and for all. Bitcoin mining is increasingly powered by renewable energy because miners seek the cheapest electricity sources, which are often stranded renewable resources. Bitcoin miners are actually helping to subsidize renewable energy development by providing a buyer for energy that would otherwise be wasted. Plus, Bitcoin replaces the entire traditional banking infrastructure: bank branches, ATMs, armored cars, data centers, all of which consume massive amounts of energy without providing the same level of security and decentralization.
And here's the kicker, Autumn. Bitcoin's energy usage is completely transparent and auditable, unlike traditional banking where energy consumption is hidden across thousands of institutions worldwide. Bitcoin uses less energy than Christmas lights in the United States, less than clothes dryers, and a fraction of what the global banking system consumes. But more importantly, Bitcoin's energy usage secures a monetary network for billions of people. That's not waste, that's the most productive use of energy in human history.
Before we sign off, let's talk about what we are expecting to see over the next 12 months, because the setup for 2026 is absolutely incredible. We've got the next Bitcoin halving coming in 2028, which historically has been followed by massive bull runs. But even before then, we're likely to see pension funds, sovereign wealth funds, and insurance companies making their first major Bitcoin allocations. When CalPERS or the Norwegian Oil Fund announces a Bitcoin position, that's when the real institutional FOMO kicks in.
And don't forget about the geopolitical implications, Autumn. As more nations adopt Bitcoin-friendly policies, we could see the emergence of Bitcoin strategic reserves at the national level. Countries like Russia, China, and even smaller nations might start accumulating Bitcoin as a hedge against US dollar dominance. When that happens, we're not just talking about corporate treasuries anymore. We're talking about a complete reshuffling of global monetary power. The next few years are going to be absolutely wild.
As we wrap up this incredible episode, let's do one final price check. Bitcoin is holding strong at $112,288, and the momentum is absolutely undeniable.
Autumn, the three key takeaways from today are crystal clear. First, over 1 million Bitcoin in corporate treasuries represents a fundamental shift in how businesses view monetary assets. Second, regulatory winds are shifting in Bitcoin's favor at the highest levels. And third, network security is reaching unprecedented levels that make Bitcoin literally untouchable.
The institutional buying pattern we're seeing isn't a trend. It's a tsunami. When allocation recommendations shift from 1% to 5%, we're talking about trillions in new demand competing for a rapidly shrinking supply. The supply shock is real, and it's happening right now.
For everyone listening, make sure to visit thebitcoinstreetjournal.com and follow our Nostra profiles for the latest updates. Remember, we're still early in this monetary revolution, but the window is closing fast.
Stack sats, stay humble, and remember, we're witnessing the birth of a new financial system. This has been the Bitcoin Street Journal podcast. I'm Autumn.
And I'm Darren. Until next time, keep stacking, keep learning, and we'll see you on the next blog.